Now, earnings season is indeed in full swing, with over half of the companies on the S&P 500 having reported results so far. 80% have seen earnings beats. That's according to FactSet. And Michael Arone is still with us, State Street Global Advisors, U.S. Spider Business Chief Investment Strategist. Mike, you mentioned earlier you think that earnings are sort of bottoming, or earnings growth, or in this case, declines, are as bad as they're going to get. Walk us through that.
So potentially, I do think this could be the bottom in the earnings cycle. So the fourth quarter, first quarter, and second quarter are all difficult. We've had sequential earnings per share growth that's been negative, and we're forecasted over the next couple quarters to be positive. Some positive signs, and ones I know that we'll chat about, is around technology. They had 5 consecutive quarters of very disappointing earnings, and now technology companies are going to grow their earnings year over year by more than 9%. So we know that they make up such a big portion of the indexes, that's going to be a positive contributor. And for all of the anxiety around financials, they continue to surprise on the upside. So financials are going to grow their earnings year over year by more than 8%. Now, I agree with most market observers that those earnings are likely to come under pressure due to regulatory response to the challenges in the March-April timeframe, due to the fact that they're going to have to increase interest on demand deposits and the like. But overall, financials and technology, 2 huge sectors of the market, are growing at 8 and 9% earnings. And that's not just that. For technology, the next several quarters are supposed to gain momentum and do even better. And that's going to be a key contributor for the market. They've already had 5 bad quarters. We're looking forward, and they're actually going to do quite well, it looks like.
So the focus is forward, especially one company that we've been watching is AMD. You know, they put out their results. They got an upgrade off the back of it. Citi upgraded AMD after its earnings. Revenue did decline, but it's kind of shrugging off any kind of backwards thinking. Earnings beat, but again, it was that kind of low bar thing, especially when you compare it. I mean, they ate 58 cents a share, beat by a penny, down from last year in terms of earnings. But again, it's that forward thinking. Is it in the tech sector? Is the focus just all about AI?
I think AI is a big component of it. And I certainly do think that as you look at AMD, part of their announcement today was an AI component, that they're going to make an AI chip for China that meets all of the regulatory requirements and things. And so the stock could be getting a little bit of a bump due to that. AI is going to be in this phase where it's a bit of everyone's going to get a premium. Everyone's talking about it. Campbell Soup's talking about AI. So it's going to get some bump as a result of that. And I think that the winners and losers will be more determined kind of in the next 18 months or so from that standpoint. I think the key here is that expectations for earnings got to such a low point. Everybody was expecting recession in the first half of the year, and it hasn't materialized. And as a result, all of these companies are easily surpassing very low expectations. And that's what I think is kind of really spurring the rally for the markets.
Mike, you sound pretty bullish.
I am. It's interesting, Julie. I've had this opinion since last August, and I was a little early. And it's this notion that the markets are not the economy and vice versa. So I do expect that as a result of all the rate hikes, that the economy will slow. Earnings will continue to be sluggish for a little bit, but I think we're hitting the bottom. And ultimately, that will find its way into the consumer and perhaps the labor market. And we're starting to see maybe the rate of growth in the labor market begin to slow. All that says, as that process unfolds, as we're chatting about, investors will look 9 to 12 months ahead. And I think they'll, I think they'll price in what will be a recovery from that perspective. I think one of the things that's kind of really interesting here is that the Fed, in some ways, has engineered a soft landing. The economy's growing, inflation has fallen dramatically, the labor market's really strong, earnings are bottoming, the stock market's up, housing's recovery. I'm just more fearful that they're not going to accept that victory. They're going to snatch defeat from the jaws of victory and keep going. I think that's the biggest risk to the market.
Meaning in September, the potential for what happens in September. And to your point, I believe it was BofA who dropped their call for, I have to double check that.
Yeah,
recession.
it was Bank of America. They're not expecting a recession any longer.
So the more people that drop this call, the more nervous that I get. So everyone was expecting a recession in the first half, and now they're bailing on that. And similarly, when Julie and I were chatting earlier around this notion of complacency, the bears are throwing in the towel.
the FOMO is coming, the fear of missing out. When this starts to happen, I tend to get a little bit more nervous in a seasonally weak period of time for markets. So it wouldn't surprise me if we have a bit of a correction in the August, September, October timeframe. But net, I have some really good news, and I'll be quick with this one, is that when the S&P is up 10% or more at this time of year, kind of in the halfway point or a little bit longer, there's only been 3 times where it hasn't accelerated that momentum. Now, those times have been really bad, so hopefully it's not. So 1987, 1929, that was really bad too, and World War II. So typically, if we're up this much at this point of the year, markets kind of build on that momentum into year end. So you're saying, am I bullish? Yeah, actually I am bullish, and I think that this will continue for at least a little while longer. The Fed and the economy are the wild cards.
All right, Michael. Thank you so much.
Great
Good
stuff.
to see you. Michael Arone is State Street Global Advisors U.S. Spider Business Chief Investment Strategist. Great to see you. Thanks so much for coming in.
My pleasure.
you.
Thank you.